Welcome to Wealth Matters Podcast. I have with me Travis Watts today. Travis is a full-time passive investor, and he has been investing in real estate since 2009 in multifamily, single family, and vacation rentals. Travis is also the director of investor relations at Ashcroft Capital, and he has invested in over 28 passive syndications between 14 different firms, or I should say operators, right? Uh,
Correct.
so, welcome, Travis.
Thanks so much for having me. Thrilled to be here.
Absolutely. So, tell us something interesting about yourself.
Oh man, I used to be like a Phil Collins style drummer and singer in a band. How about that?
Wow, that is interesting.
Has nothing to do with anything. I just want to share that.
Right. No, and that's what I wanted to know as well. so, so tell us about your story. How did you go from drummer to oil field worker to passive investor?
Oh man, that is a funny topic. I always have to laugh when if you really look at my resume, it makes no sense at all. The only thing that's been consistent really is real estate. So, I had read a book early on back in high school actually, and it was Rich Dad Prophecy. I know a lot of people read Rich Dad Poor Dad obviously when they get into real estate or right before. This basically was my eye opener into the world of finance and investing. About 2005, 2006. And all I really took away from that book is don't be in the stock market because we're going to have this big stock market meltdown at some point. So I took that advice. I didn't have any other mentors or anyone telling me anything else. So I was fortunate to have kind of watched the Great Recession unfold without participating in it as I was going to college. So 2009 rolled around and I knew I wanted to get into real estate at some point. I didn't know how or when or anything about it, but real estate was obviously on sale in the fall of 2009.
Yes.
I was looking at a property in Colorado where I was from, and it had previously sold for about $165,000 and it was for sale for $95,000. Wasn't even really a distressed property. It was just 2-bed, 1-bath. It was really nice. So I thought, okay, government was giving out an $8,000 first-time home buyer stimulus package.
Right.
I thought, well, hey, I'll couple that with a discounted piece of property and let's give it a whirl and see what happens. And I didn't know what I was doing. I didn't have any mentors, and I started house hacking is really how my journey started.
Wow. So you did not know about real estate and you started. So you are like me where you just jump into it, right? You take action, which is what I like though. Because you see a lot more tire kickers, even though there is so much education out there, bigger pockets to Joe's podcast, Joe Fairless, my podcast. There is way too many things, and still people just listen and learn and learn and learn and then never take action. Right?
Yep, absolutely. We'll talk about that for sure.
Yeah,
but,
and then house hacking too, which no one knew.
Yeah, I guess there were other. I was on a podcast the other day, and the host says that used to be called "I'm broke and I need help paying my rent." Well, you can call it that too, I guess. So anyway, it was an eye opener to me. It was kind of in a sense the first passive income, so to speak, that I experienced firsthand. Someone was handing me a check every month that was basically paying my mortgage. So that was enlightening. And so from there, I ended up turning that property into a buy and hold rental long-term. I ended up getting into some fix and flips and vacation rentals. And I did a lot of hands-on active single family stuff for the next several years. To the point that I burned myself out. So as I was scaling along, I was working an oil field job. That was a ton of hours. It was like 14 hours a day, 98-hour work weeks. I was away from home. I worked in the Middle East for several years. And it just got to be overwhelming. I just couldn't handle it. I couldn't do that type of work. I couldn't be scaling and flipping and doing all this other stuff. So I had to kind of go back to the drawing board in 2015 and think. I had to do a lot of self-reflection, a lot of just looking in the mirror and just saying, what are your strengths? What are you trying to do here? What are you good at? And that's where I learned about private placement investing. A lot of people, syndications, obviously, just the ability to be a hands-off investor, but still participate in the benefits of real estate, as we all love and know the tax benefits and the cash flow and everything else. So I made a big pivot 2015 to 2016. I sold all my single family homes. I went completely from active to passive, and I've been full-time passive investor ever since 2015-16 through today. Yeah.
So how did you go from, of course, you explained that, but what made you make that switch? Scaling up is hard, but did you look into your goals, your risk investment criteria, etc.?
Yeah, exactly. So the first thing that I did as I was really self-reflecting and thinking, what is it I really want about all this stuff? What I really wanted was passive income. And that's sort of why I started out doing what I was doing back in the day. I just didn't have clear vision or goals set. So what I did is I for the first time, I did like a detailed, very, very detailed net worth calculation. I started saying, if I sold everything I own and I paid all the tax and I paid the realtor commissions and the fees and everything, what am I left with? Net worth, essentially. What if I place that capital into these syndications, 50K here and 25 there and 75 here, conservatively, what would that cash flow look like? And for me, it was enough to quit the oil field job that I really didn't like. It really didn't fit me. I was going nowhere with that. And that was my original why, why passive income, to quit this job, that I didn't feel was going to be sustainable anyhow. It's a boom and bust cycle,
right?
As we all know.
And we just saw that a month ago.
Yeah, I know. It's tragic. I still have a few, connections out there in the industry, and it's
it's difficult. Yes,
it's very difficult. So yeah, that's kind of the how. I mean, there's not too much to it. It just took a lot of, goal setting and self-reflection.
So how can someone get started with goal setting?
Yeah, that's a good question. So we all learn differently, obviously. Some folks do better in an environment, let's say like a coaching or a mentoring program. Some people are cool with reading a book about goal setting and how to do it. And others are just motivated just to sit down and do it. That was kind of more, my approach that I took. But I'm a huge fan of like Tony Robbins. Tony talks all about mindset and goals, and attend to seminars, or he's got audiobooks and regular books and programs, downloads, all this stuff. Plenty of other folks out there I know, like the real estate guys, they have an annual summit that they do about goal setting.
The future,
Yeah. So, and these are all great. I'm all for all this stuff. It just depends on you, the individual, and how are you going to, push yourself to do this. And, I just sat down and did it, really. I just sat down to say, honestly, I wasn't that good at fix and flips or vacation rentals. I didn't enjoy the business of real estate. I didn't like managing tenants. I didn't like taking all my time away on the weekends to go drive neighborhoods and try to find properties. It wasn't for me, and I had to self-discover that, over time. So, programs, mentors, coaches, books, self-motivation, YouTube videos. There's all kinds of approaches, but at the end of the day, I think it's critically important that you set goals and to determine what you're really after and why.
That's awesome. What did you have to do to figure out risk tolerance and investment criteria?
Yeah, those are two critically important things as well. So obviously with investing, no matter what we're talking about in the world of investing, there's always risk. So it's and like there's all these quotes out there that are like flooding in right now to my head, but like Warren Buffett says, risk comes from not knowing what you're doing, essentially. Or Robert Kiyosaki talks about, when your education goes up, your risk goes down. And I agree with all this stuff. It's true. So what you have to look at is, to me anyway, I don't want to ever put all my eggs in one basket, so to speak. So
that
when
is
I started
true.
when the diversification 101. So when I started doing the syndication stuff, I wasn't just going to sell everything and go put, a huge lump sum into one deal and then hope that
and
worked out.
in one operator, in one asset type, right?
In one market even. So, I'm diversified across a lot of the U.S., not every state, obviously not every market, but usually B and C class value add plans, but with 14 operators, as you pointed out earlier, a large one obviously being Ashcroft Capital. But yeah, it's important to have that kind of spread diversification. Absolutely. And as far as criteria, I think that was your second question. It gets back to, again, kind of knowing yourself, self-educating in the space, understanding that, hey, there's mobile home parks, there's self-storage, there's multifamily, there's new development, there's office, there's retail, there's so much. You've got to start, number one, just being aware that all of that exists, that all of that's an opportunity and a possibility. But more importantly, what's important to you? You know, in general, it's kind of the higher risk, higher return. But you know, does that sit well with you? It doesn't always sit well with me. I'm more of a conservative investor, so I like to buy things, you know, at a discount where the rents are undervalued, but it's still stabilized and cash flowing day one, so that even if we stop doing the business plan, there's still some income to be had from a property. So, so I kind of, you know, again, I sat down with my wife. We weren't married yet, but we were kind of making these goals of being in real estate long term, and just wrote down things like monthly distributions, monthly reporting, transparency from the team, track record, experience, you know, the states that we like, the markets that we like, or just high level stuff, just bullet points. And then finding operators that align with that. I mean, that was kind of the process that we took, and the process that I still take. So until you can define your own criteria and your own goals, your own philosophy, it's hard to align yourself with other folks, because, you know, it may be a right fit or it may be a wrong fit for you.
No, that's great. So, of course, you have to start with knowing yourself, setting your goals, and then every person has different risk tolerance and investment criteria. No one person is same. It's like fingerprint. Everyone thinks of, you know, sometimes I go bullish on, you know, cryptocurrencies, and I don't care. I know it's an asymmetric risk, so I'm going to lose it all. But if I'm investing my money in multifamily or mobile home park, I become conservative because I want to keep my principal, right? I don't want to lose my shirt. So again, you know, it depends from one person to another. So these are really important points, though, having goals and then your criteria and figuring out what you're really looking for, right? From risk tolerance perspective as well. So let's say you had all this and you mentioned about self-education. How did you start? Where did you start?
Yeah, good question. I kind of immersed myself in a lot of different outlets, some of which worked extremely well. Others were just so-so, and some were not helpful. So for me, leading up to this whole lockdown and COVID and all that, I was going around nationwide to conferences, just networking with folks, right? To me, I got the most value out of that, just a face-to-face conversation. And, you know, who do you invest with? What's your experience been? How about this group? You hear anything about them? And you pick up so much when you talk to thousands and thousands of investors that way. If you're not the type to want to do that, or, you know, you don't want to spend thousands of dollars traveling the country to do that, Bigger Pockets is a great forum. There's plenty of other forums online, but just the idea being you can network at home too, and you can post like, hey, I'm looking at getting into this world of syndications. Does anyone have any advice for me, or anyone willing to connect with me and share your experience? That's a great way to do it too. You know, the simple stuff, podcasting, obviously, huge help. Books were a huge help, but not as effective as, for example, finding a mentor. And a mentor could be a book or podcast or YouTube, or it could be a face-to-face interaction, which to me is the most effective. But it's finding the people that are doing what you want to do and then connecting with them, right? Adding value back to them, not just, can I pick your brain for 1 hour?
Right.
You know, not a lot of people have time for that. But, you know, hey, if I, show you how to enhance your LinkedIn profile or your Instagram page, could you, you know, give me some tips or something next week on how to get started in this industry? Whatever it may be, you know, use your own skill set to add value to others, or try to intern with them for free for a little while or something like that.
So at what point did you figure out that you need a mentor, and what kind of mentor did you choose? Was it a personal development mentor, business mentor, or real estate mentor?
Yeah, good question. Specifically, the path that I chose was I started joining real estate meetup groups. Some were kind of like more nationwide stuff, and some were local. I found two people specifically that were willing to kind of take me on, put me under their wing, so to speak. And these folks had, a 10x net worth to me. They had done 10x what I was even planning to do. I mean, these are some pretty heavy hitters, and I was actually quite shocked they were willing to share their information with me. So two people in my network to kind of do that. I didn't go overkill. I didn't try to find like 20 mentors. Yeah. Everyone's got an opinion. It just confuses you. But two people that I aligned with, in addition to Bigger Pockets, in addition to reading, in addition to podcasts, all that kind of stuff. So, and also the best experience is to take an educated, conservative experiment, like just do a deal. What I mean? And just ask the sponsor team questions and just learn. At some point, to your point earlier in our conversation, you just have to take action at a certain point. And that's critical.
Yeah. So theory is all good, but you got to do some kind of practical experiments.
100%. Yep.
And so, it's interesting to hear that 28 investments, 14 different operators. I'm pretty sure you had some great experience and not so good experience, right? So would you care to share your best and worst investment as well as, things you learned from those?
Sure. Yeah. Start with, two short stories on kind of a success story. I did have success in the single family space. There was one property in particular I had bought and held for about 2 years as a rental and sold. And I really didn't have to do anything with it. And I ended up doubling my money on that. So that was pretty incredible. And I'm very fortunate to have had that experience.
That was just the market, right?
That was just the market. The market.
Not to say anything about, but some of the syndicators I talked to, and they're like, "Oh yeah, we doubled the money in 2 years." I'm like, "You didn't have to do anything."
Yeah.
Sometimes
totally
this is just the market.
So let's get into that example. So let's move it to like syndication stuff. So I partnered with a group where this particular sponsor was pretty inexperienced. I think it was their second deal that they had ever done. And, it was a big value add, several hundred units. I forget the unit count, but they had bought for the right price. They had bought a good asset and they bought in a great market at a great time. This was maybe around 2016 or something like that. Well, to no credit to the sponsor, they butchered the entire business plan up. They made every wrong decision they could make. They fired the property management company. They fired one of their own partners. And it was such a nightmare and a mess. But at the end of the day, about 18 months in, this was supposed to be a 5 to 7 year hold. Mm-hmm. They had renovated just not many units, but they just put it up for sale. And we ended up all making like a double-digit profit on it, which was incredible. But to your point, it was the market. It was the market. Yeah. So in today's environment, you have to be so much more focused on the team and their expertise and their ability to execute and how conservative this business plan is going to be, because you can get yourself in a situation like that, which thankfully wasn't like a loss of money, but it was certainly a hassle and a headache for 18 months.
Oh yeah. I believe you. I have invested in a syndication 3 years ago, and I'm yet to get paid. And they have made blunders one after another. So I know how it feels.
Yeah. 100%.
So was there any time where you lost money on a deal, syndication?
There was I guess you could call it a syndication. It was kind of like a fund. It was a private placement fund that did distressed debt investing. Okay. So they were buying defaulted debt, off of the banks, and then they were trying to collect on that and make them performing again. And just to back up one step, so I do 80% of my investing in what I know and understand, and, that really resonates with me, I'm comfortable with. And I do 20% as kind of experimental things that I think, you talked about Bitcoin or crypto.
You got to try it.
You got to try. Sometimes you triple your money. That's incredible. Yeah. Other times, like in my case, you lose
everything.
Your money. So this was a fund. And what I didn't understand about this fund, I did all my due diligence on the people who had created the fund, but what I realistically couldn't do is all my due diligence on all the key players that were involved. So there was a lot of like integrated partnerships nationwide with all these people and firms. Well, long story short, 35% of this fund was allocated to a group out on the East Coast that ended up being a Ponzi scheme. So when that got unveiled, we basically just lost 35% of our money overnight. And then it went into the whole, receivership, and what a mess.
Yes.
So not only a financial loss, but again, a headache, a hassle.
Yeah.
And the bottom line was it was just one of these experimental things. They really hadn't done it before. They picked all these partners that, whatever. But so, yeah, I did lose money in that. I haven't yet lost money in a multifamily deal, but I'm sure, the day will come.
Yes.
Be prepared.
But that's why you diversify, right? Because not every time it's a home run, right? So you want to make sure that you diversify, you stay conservative. And as you said, once you find one or two good operators, stay with them. Of course, still try to expand into different markets and asset types if it's possible.
Yeah.
All right. So what's your best deal or investment so far?
Best investment in the syndication space was one I did with a group. It was out in Phoenix, and it's like a 400 unit, give or take. And we were, again, it was like a 5 to 7 year plan. We didn't have an exact exit point per se.
Right.
It was flexible. About 12 months in, maybe 14 months in, we just got this random offer that came in. Just totally curveball, and it was incredible. I mean, it was such a great offer that it's like the general partners, why would we keep holding it? When we can give all the investors more than they were anticipating all right now up front and not have to wait 5 years. So they took it. I don't know. It was like a, just under a 40% IRR return in a little over a year. It was incredible.
Wow. Yeah,
so it really, it did well. But again, the market, the timing, they had bought right, yada, yada. And the luck of getting an offer like that when it wasn't even listed. It was totally an off-market situation. So, so that was a great success story that I was part of. Yep.
That's awesome. So what did you learn from the, deal from where you lost money as well as the deal where you made money?
Yeah,
pretty good amount of money.
Yeah, it's funny because both those that I just described, the 30-some% return / I lost 30-some%, right? They kind of canceled each other out, right? So kind of sucks. Took away my thunder. But what did I learn is basically invest in what you know and understand. And if you do invest in experimental stuff, it's cool, but limit your exposure there. Don't put all your eggs in one basket. To be the news headline of the people that put their entire life savings into Bitcoin and lost it all or whatever. You hear all these crazy extremes. Same
with 401ks, right? People are like waiting, I got to retire. I have everything in 401k. And then they right around when you're retiring, it busts, right? Like what we see in March.
Yeah, exactly. I was talking to a gentleman a couple months ago, I think it was, and he had done his first syndication deal, and before that he had just sold his business. So we're talking a number roughly around $1 million, and I was just curious, and I was like, oh cool, like what operator did you work with? What was the deal all about? Well, he shared with me the overview, and I'm like, holy cow, like it not saying it's going to be like a disaster for him, but it's not a good deal. And so to that point, boy, I wish that he could have just put like $100K into it, right? And then done 9 other deals that would help soften the blow, because I don't think it's going to go well. But we'll see. I don't know.
Yeah, I know a friend who invests in real estate as well on his own, and he was telling me recently he had just put $500,000, and they're constructing a brand new hotel, right? Like end of last year they started, and now we see what happened. Right now, by end of the year, we'll see that there will be hotels on sale in the same area, right? Because hospitality got clobbered.
Yep.
So like, you don't put all of that money in one place. Same thing.
Yeah, this is part of what made me uncomfortable when I was in the single family space. Is I started building up quite a bit of equity in each property. And that started really making me uncomfortable to think, I've got $200K here and 2 there and 2 there, whatever. And what if a big flood comes through, or there's a big political change in
This
Colorado,
can
or
wipe
blah, blah,
out
blah.
everything. Yes.
Yeah, I'm all in single family. I'm all within a 10-mile radius. And it's like, I just started kind of getting antsy to get out of that situation and start diversifying. So
I think you did awesome. So this was awesome. Let's take a quick break. And after the break, we'll go through fire round.
All right.
Welcome back to Wealth Matters Podcast, and I'm chatting with Travis Watts about goals, risk tolerance, and investment criteria. But we'll move on to fire round now. Travis, are you ready?
No, I'm ready. Let's do it.
Okay. What do you see would be the impact of COVID-19 on real estate?
Wow, that's a crystal ball question. Wish I had one.
Again, I don't think anyone could predict, but I'm just trying to collect as much knowledge as possible.
The best way I can look at all this is just from the general standpoint of having a recession, right? So before I got into multifamily and affordable housing, so to speak, I did a lot of back testing and a lot of looking at what happened in 2008, 9, 10 with multifamily. I wanted to be in an asset class that was recession resistant. Mm-hmm. There's really no such thing as recession proof, but it just, everybody, yes, needs a place to live. Not everyone needs the highest upper end, brand new, high end, 4,000 a month finishes, yada, yada. So I just wanted to be in something like that. I also invest in self-storage or ATM machines and blah, blah, blah. So a lot of assets that are recession resistant. So we're only a few months in. No one knows the future, but basically so far so good. I mean, yes, it's had an impact, not as much as, office, retail, short-term rentals. There's a lot of sectors that have been hit a lot harder. So we'll see, but I'm still bullish long-term. Not a lot's changed in terms of looking forward and continuing on. Yeah.
Awesome. Would you be changing any business or investment strategy after coronavirus?
No, but with a caveat. So the thing about publicly traded markets, like the stock market, so it's always, in my opinion, an overreaction. We're way overblown, or it's way too low than what it should be, and it's up and down. So when you hit those crazy peaks and valleys, there's always an opportunity there to either sell or to buy. If I'm liquid and in a position to buy some REITs, let's say real estate investment trusts that have a high dividend distribution that's very diversified, blah, 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 and it's fallen 40, 50, 60%. Okay. I do see me kind of shifting over to maybe doing some of that, which I did here recently back in March. And then, as you get overblown and overinflated again, maybe sell. And in some cases, that could be a tremendous opportunity. But of course, I don't advocate trying to time markets. The only reason I
no one can.
You can't. So the only reason I would get in is when it's at a very low that I feel is just overdone and not realistic compared to what's really happening. And I would want to be in it anyway. Back to risk tolerance. If it kept going down, fine. I still think it's good to be in it.
That's so important what you mentioned, that you really want to be in it anyway, right? It does not matter at that point, that even if it goes down, you still see value in it. Yeah. And not, again, I'm not recommending anything, but let's say Colgate Palmolive stock. I know Colgate, it's if I like the stock, if I like the company, I know that I want to be in it. And at a certain point, I don't care.
Yeah, exactly. That's so great. That might be a change, but other than that, still a syndication guy. So
that's awesome. Favorite real estate or finance or any other related book?
Two books that come to mind. We talked about kind of knowing yourself. You'd asked some questions there. I forgot to mention this, but Peter Drucker has a really great book. It's a very short book. It's called Managing Oneself, and it's like a $2 Audible book if you're into audiobooks, or like a 45-page book. It's so short, but it's so to the point, years of experience, blah, blah, blah. And it's about knowing your strengths and knowing yourself and how to make those decisions based off of that. He uses a lot of practical examples of presidents and whatnot. So that's a great book. Read that many times. What's another one? Tom Wheelwright's book, Tax-Free Wealth.
Oh yeah, I love that book.
There's a new edition since the tax code had changed. Yeah.
Yes. Mm-hmm. Yeah. No, that's a great book.
whether you're into real estate or just investing in general, small business ownership, big business ownership, there's a lot of practical, easy takeaways you can share with your CPA. And if they're not in the know already. And those are 2 books that I love and that have helped me a lot.
Awesome. Any tool, app, or a website you can't live without, or maybe it adds tremendous value to your business or investment strategy?
I love Zoom calls. I've loved Zoom before the lockdown. I've loved Zoom before the podcast. Yes. It's such a great tool for free in most cases, just to connect with people. And what I talk to people a lot about is having a face-to-face meeting with a sponsor before you invest with them. And I realized that, you live in California and here the sponsors in New York City. Right. It's not practical to jump on a plane and get a hotel and to go have a 5-minute meeting. But, jump on a Zoom call instead. It's free. Right. And you can set it up like next day, same day. So that's a tremendous tool / website, software, whatever.
Yeah, I highly recommend.
Yeah, same.
How do you give back?
My time. So I spend my weeks in 15 to 30-minute intervals giving away my time to others, whether it's an 18-year-old looking to house hack, whether it's a 70-year-old that wants to know what a private placement means, and anyone in between, accredited, non-accredited. So I think I sent you a link. If not, I will for the show notes. But feel free to connect with me. You can also go to ashcroftcapital.com/connect with Travis and set up your call there. And happy to do just a general Q&A. Anything on this podcast that you have questions about, didn't make sense, you want to dive deeper in, I give away my time to people. And because I'm passionate about what I do, and that's how I love to help.
That's great. How can my listeners reach out to you?
That's the best way. ashcroftcapital.com/connect with Travis, or I'm on Bigger Pockets, LinkedIn, Facebook, Instagram. Instagram and Facebook, I think, are at Passive Investor Tips. Okay. And you can follow me there.
So it's easy to find you, basically.
Yeah. Google Travis Watts Podcast. There you go.
Awesome. Thank you, Travis. Have a great day.
Thanks so much. Have a good one.